Welcome back to Investing Talk Podcast.
Today we're looking at Nauticus Robotics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you really stack up all the recent corporate actions, the overwhelming impression isn't, smooth growth.
Not at all.
It's a management team that is deep in the middle of, financial and regulatory triage.
Triage is a strong word. For people listening, what specific actions are signaling that level of stress? We're not just talking standard business turbulence here.
No, not at all.
Yeah.
The most immediate and, frankly, classic signal of distress was the 1-for-9 reverse stock split.
Right.
They executed that just a few months ago on September 5, 2025.
And that's a move you make for one reason, pretty much.
Exactly. It's almost universally a direct response to a stock that's just chronically trading below that $1 minimum you need for a Nasdaq listing. They had to, condense 9 shares into one just to lift the price on paper.
It feels like the financial equivalent of just rearranging the deck chairs. It's an administrative fix. It's not. It doesn't solve the underlying problem of why the stock was so low in the first place.
It absolutely does not. It tells the market the company was on the brink of getting delisted. And while the initial problem was the price, their response points to much deeper issues.
Like what?
They faced delisting risk when their market cap actually fell below $35 million. Now, they managed to achieve technical compliance, at least for a while, by February 18, 2025.
How did they do that?
By satisfying an alternative rule. It's known as the equity rule.
Okay, let's pause there because those two things get confused a lot. Can you just break down the difference between the $1 price rule and this equity rule?
Sure. The $1 rule is simple. Stay above $1. The equity rule is, it's a different kind of life raft. It requires the company to maintain a minimum of $2.5 million in stockholders' equity.
So basically they're saying, look, our price is low, but we still have a functional balance sheet.
That's the idea. It's a way to show Nasdaq they're still viable, but it really just buys them time.
It sounds like a temporary bandage, not a long-term solution.
It is. And critically, even though they technically achieved compliance with that rule, the stock is not in the clear. Not by a long shot.
Yeah.
It's still under what's called a discretionary panel monitor.
Which sounds like you're on probation.
Do it exactly like that. Financial academic probation.
Yeah.
You're allowed to stay, but the watch is on, and the standards are now much, much stricter.
Okay, so that monitor sounds like some serious oversight. But this is the part of the story that just seems to defy all logic. How does a company that's actively fighting delisting suddenly get a massive $250 million capital infusion? I mean, we all saw the news about that $250 million equity line of credit, the ELOC, back in October.
And this is where the whole narrative just flips on its head. It goes from a near-death experience to massive optionality.
It's a huge vote of confidence.
A colossal vote of confidence.
Yeah.
It completely removes that immediate existential financing risk. It gives them a tremendous runway for R&D, for growth, whatever they need.
I agree the size is impressive, but we have to break down how this capital actually works. An equity line of credit isn't just a lump sum check for $250 million, is it?
No, and that's a critical distinction you have to understand. It's not a loan. It's a commitment from the investor that the company can draw down capital by selling new shares to them over time.
So the timing and the price are tied to the market.
Precisely.
Yeah.
So if the stock price drops, they have to sell more shares just to raise the same amount of cash.
Which creates dilution risk for everyone else.
Exactly. It's an inherent risk. The company is selling shares, often at a discount, right into the market. It's flexible, which is good for them, but it comes at a cost to existing shareholders.
That definitely frames it more realistically. But still, a $250 million commitment is serious. Was that the only capital they raised?
No. They also raised a smaller, but still significant $2.94 million in August via Series B convertible preferred stock.
So again, there's institutional interest there, despite all the public drama.
Yes. Management has clearly been laser-focused on fixing the balance sheet, first and foremost.
And it also looks like they're trying to speed up their internal decision-making. Tell us about that change to the stockholder quorum.
This is the managerial angle on urgency, right? On August 15th, the board cut the stockholder quorum requirement down to just 33.33% of voting power.
So they need fewer shareholders to show up to vote on something.
Way fewer. By lowering it from what was likely a majority, management is signaling they want to streamline decisions, and dramatically so.
Now, management always frames that as, efficiency. But is there a potential negative way to look at that?
Of course.
Couldn't it also mean they're trying to push through important, maybe even unpopular strategic moves without needing a broad consensus?
That is the analytical counterpoint you have to consider. While faster execution is the positive story, it also lowers the bar for shareholder agreement. It signals an urgency to act, and they want to ensure minority shareholders can't slow them down.
So we've got this wild narrative. A company on life support doing a reverse split suddenly gets $250 million and streamlines its board to move fast. But here's the black hole in this whole story.
The missing data.
The massive holes in the fundamental data. How can anyone commit $250 million when we have zero idea about their operational performance?
It's what makes this so fascinating. The sheer opacity of it all. The capital structure changes are all very public. The operational performance, it's non-existent. We are flying completely blind.
And when you say flying blind, what exactly is missing? What would an investor normally be looking for?
Everything. We have no recent revenue figures. We're missing Q1, Q2, and Q3 of 2025.
Fake quarters.
3 consecutive quarters with zero public visibility into their core business.
Wow. Missing a single quarter is a red flag. Missing 3, especially in a sector like robotics, means you have no idea if they're growing or sinking.
Exactly. And beyond revenue, we have no idea about gross margins, operating margins. We can't analyze cash burn.
Nothing on customers, retention.
No public info on customer traction, retention rates, or how their competitive mode is holding up. All the crucial metrics that should, validate a $250 million investment, they're completely opaque.
So that brings us back to looking at that massive ELSC with a lot of skepticism. If we don't know the burn rate, could this massive capital line actually be a negative signal?
How so?
I mean, could it imply they're burning cash so fast they needed a nuclear financing option just to survive the next year, not just to fund expansion?
That is the crucial, challenging question. Without the 10Q filings, that ELOC could very well be a massive lifeline to cover unsustainable cash burn. It's a show-me story where the show just hasn't started yet. We just have to assume the institutional investor did better due diligence than we can do from the outside.
Which leads us right back to the most acute danger here. The binary risk you just can't ignore. We talked about the monitor, but what's the final hard deadline?
This is the date everyone needs circled. February 18th, 2026.
Okay.
That is the expiration date of their grace period under the Nasdaq monitor. They aren't fighting over the $1 rule anymore. They are fighting to maintain compliance with that equity rule.
And if they fail by February 18th, what happens? Is there another appeal?
No, there's no margin for error left. Any failure to maintain that minimum $2.5 million in stockholders' equity triggers automatic delisting.
And just gone.
They fall off the face of the institutional investment world.
Can you just explain the real-world consequences of that? What happens to the stock besides, moving to an over-the-counter market?
The consequences are severe. First, you lose access to most institutional investors in mutual funds. Their mandates just prohibit them from holding non-listed stocks.
So forced selling?
Forced selling from index funds, exactly, which pushes the price down. And third, and most crucially, it causes a severe liquidity impairment.
Which means you might struggle to even sell your shares when you want to, right? At any reasonable price.
Precisely. The pool of buyers just dries up. This risk is acute, it's imminent, and I don't think it's fully accounted for in the current price.
Okay, so this is a high-wire act. A huge capital commitment on one side and an existential deadline with zero operational transparency on the other. What should investors be watching for over the next few months to get the data they need?
Well, the calendar is packed between December and February. The final do-or-die date is that formal panel monitor compliance review on February 18th, 2026. That's when Nasdaq makes the final call.
And what about the missing data? When will management finally break the silence?
We should see the Q3 2025 earnings release sometime in January or February of 2026. That is the big opportunity for them.
Their chance to tell a story.
They have to. They must use that release to show credible revenue, to give us visibility into margins, and, critically, to explain why the last 3 quarters of data were missing.
And that's also when they need to show how that $250 million is being used, right? To validate that commitment.
Absolutely. We need clarity. Is it going into R&D, M&A? Are they announcing major new customer wins? That's the data that transforms the narrative from, speculative financing to a genuine growth story.
So if you had to summarize the investment thesis, this tightrope walk, where does it land for someone thinking about investing?
It lands firmly in high-risk speculation. It requires a very specific profile, a highly risk-tolerant portfolio, and an entry that really should be contingent on two things.
Which are?
First, they successfully resolve the delisting risk. And second, we actually see some of that positive operational data finally appear. The time horizon, assuming they even survive, has to be 12 to 24 months.
So this is not for the faint of heart. The story right now isn't about market growth. It's about balance sheet survival and proving operational transparency before that critical February deadline.
Precisely. The company's immediate future hinges entirely on those two things. That is the core challenge management faces in the next 3 months.
A fascinating high-stakes analysis. Make sure you subscribe to Investing Talk podcast so you don't miss our next analysis.